All right, we've got about one more minute until we're gonna get live and get into our weekly analysis. So if you guys are here in the chat, let me know. I'd love to see everyone popping in nice and early on time. Hoping we take stock suggestions. We're always taking stock suggestions. SRI 31, thank you for the follow before we get into it. And like we always do, we're just gonna keep kind of a running list on the side for any stock suggestions that you guys might have. So I'll at least have them up in front of me, so I'll be sure to get around to everything that people recommend. And USA JMG 93F, thank you for the follow as well. That's good. We got two before we even kicked it off tonight. I love it. I love it. ENPH, we will throw it on there for you. All right, it is time to begin. So let me get this out of the way. And welcome back, Kyle, in the YouTube chat. Always appreciate the when people are checking in the chat before we get started. We've got some more stock suggestions too, so let me throw those on my list. EBON, CLSK, UWMC. We're going to talk about CCs. Yeah, we're definitely going to talk about UWMC. That's been an awesome one for us today. And for those of you that have been following along on that one, I know you guys probably had an awesome day as well, as that thing went up, I think 10% total if we include the after hours price movement. So that is something we love to see. We'll pull the chart up right here to look at it really quickly, because nothing quite like sitting back at the end of the day when the market's all closed and taking a look at a chart that did exactly what you wanted it to do for a good 9 hours in a row. So that's always fun to look at. But quickly, we're going to start off with how we normally start off, just recapping what we've done throughout the week so far. So kind of getting back at this again, as a lot of you know, we've got this pretty big position in UWMC. We've made all these videos about how great we think UWMC is as an investment. And today it's finally started to pay off as it closed at $9.05. But the best part is that it went up to about $9.40 after hours. So what does that mean for us right now? So right now we've got a pretty solid gain. I think 52.96. We're going to show you the effect of this really quickly. Just based off the closing price of where the stock closed at 4 p.m. and what the options were trading at when the market closed, we've made 52.96 from this stock. However, if this thing stays up at, we'll call it 9.35 to be conservative. If it stays at 9.35 by the end of the week and just trades flat from where it is right here, this is going to be worth 65 cents. These are going to be worthless, and we are then going to have what is a $7,836 gain on the trade, which means that just if this thing stays flat from where it is after hours, we're getting another $2,500, and that's why we're so excited about UWMC right now, because really this is kind of the best case scenario for us. Obviously, we'd love if it got all the way up to 10 and these 10 strike puts that we have. I'll make this a little bit bigger. We'd love if these 10 strike puts that we had expired worthless, but from where we were, I mean, a little over a week ago, we could go back to the 10-day chart on this one when we dipped below $8 a share. Things are looking a lot better for us here. Our break even on the trade overall is 820. Even just having this pop back up is going to make it so much more manageable. Even if it doesn't get back up to 10, even if it just dips back below 9, where maybe we'd lose a little bit of money from here, but it makes it so much more manageable with the amount of premium we can collect as we roll these positions forward into April. So we love the price movement from that today. VGAC, that's one we're just probably going to have to keep at the back of our portfolio, keep selling calls on that, and just forget about it on a month-to-month basis and eventually hope that our cost basis catches up with the price of the stock. PSTH is another exciting one. We've been talking about this one a bunch. This is the SPAC from Bill Ackman. Take a look at the chart here. 10-day chart again, it sucked. Obviously, this was that one day in the market, March 5th, where a lot of things pulled back pretty sharply, but then rebounded. Earlier in the week, it got up to about 28.58, so had a little bit of juice in it before settling down to 27.20 by the end of the day today. We've got 30 strike puts, which we're probably going to roll to the following week for a credit. We're going to let these expire and then sell more 31 calls potentially on Friday once these are just about worthless. So we could take a look at, previewing what that would look like. These are warrants, so we're going to ignore this row right here. But right now, the 31s are decently out of the money, so we can't even see them when we show 14 strikes. But looking at what we could expect to get if we open them again next week, what's crazy about this one is that, 27.23 is pretty far out of the money right here for PSTH. But we could still sell 31 strike calls for about 80 cents as of market close today. Now that might drop a little bit by Friday when we're actually going to make this play, but not too big of a deal. I think it's awesome that we could sell so far out of the money and still collect this awesome premium that's going to drop our basis even further. And then as far as rolling these 30 strike puts are concerned, we could close for about $3 and then open another set for $3.80. So that's another 80-cent credit on that trade. So between the 80 cents on the put side and the 80 cents of premium on the call side, we're going to be able to lower our cost basis by a full $1.60 just in 1 week on this. And I think we're at 27.10 as our cost basis right now. So that means we're going to be able to get into the 25s for a cost basis. And then at the end of next week, we'll be able to get it down even further. And that's the beauty of selling calls over and over and over again and collecting this option premium. We got a question in the YouTube chat about where we learned how to trade. We've got someone who's fairly new, looking for a good place to start to learn and doesn't want to pay $100 or $1,000 on a course. Perfectly reasonable question to ask. Everyone starts somewhere. All these people out here, I think social media is so toxic when you try to buy in and pay attention to all these people who are saying, oh, I could help you make this much money. I could help you make this much money in a month. I would really encourage people to stay away from that mindset and stick in the mindset of expecting, smaller gains are going to compound into bigger gains. And to learn that, you need to learn the overall market. There's not going to be some guru out there who's going to find a way to help you trade options overnight and make 1,000% in a month. That kind of investing is the equivalent of gambling, and I would encourage everyone to stay away from any course that leads you down that road. And I didn't use any courses. We don't sell a course. We just teach everything either through these streams on our YouTube channel and then in our Discord server. But the way I look at it, we do option selling primarily. So if you're new to investing, this might be a little bit over your head, and that's not to say that you can't pick it up pretty quickly, but the way I see it, there are really kind of 3 tiers of knowledge when you're learning option selling. The first is just general trading, and I think on YouTube there are several great resources for that. I mean, if you just go to the YouTube channel right at the beginning, we could say something like just trading for beginners. And I mean, it doesn't even have to be anything that involved. I'm sure this hour and 30-minute video, if you've got the time to invest, probably does a pretty good job of laying out basic trading concepts, getting you familiar with the market. The other thing I would suggest is just, creating a watch list like we have laid out right here, getting familiar with different stocks, potentially buying a couple of stocks and companies that you like, such as, maybe you're an Apple fan, just buy a share or two of Apple, let it ride, and just understand how the market moves day to day, week to week, month to month. I think that's the best way to get yourself acquainted with that first step of just general market understanding. The second is, understanding how options work themselves, how trading options work. So there's one, I think options trading for beginners. These search terms are pretty basic. This is the one I typically point people to, and we have a link also in our Discord server about a Tasty Trade options course. They do a really good job of teaching options basics. But then once you have those two things figured out, the basic trading concepts, and then combine that with how options work, I think that's when you could reach this third step of knowledge, which is what we teach with options selling. And I think we do, a decent enough job of that through our YouTube channel. And then if you have any, residual questions about things like that, we're always happy to answer those in our Discord server. And I think we've got several super intelligent, smart, and helpful people in that server who are always willing to help out. So I think that's a great place to be. But that kind of sums up my thoughts on, if you're new to the market, you're trying to figure out how to do what we do, that's typically the path that I would recommend you start on and follow as you try to, grasp some of the concepts that we're using when we trade. And then kind of, random side note, I would love to figure out how to, make a actual thumbnail for this as opposed to having just some random screenshot of our screen, but whatever. We'll figure that one out at a different time. Back to our plays on the week, we talked about PSTH. LOTZ is another big one that we've got a position in. We actually rolled those puts out to April this week, or I think we did it today. So the effect of that was we closed this initial set out for $1.35, which is a small loss on that. And our initial break-even price was, $8 and it's whatever 10 minus 1.17. It was $8.83, our initial break-even price. What we were able to do was close these out for $1.35, so small loss on the March ones, but we're able to open the same exact strike for April for $1.90 of credit, meaning that if LOTZ goes up to 10, we hit max profit. Good news, we're still hitting a 20% return in just under 2 months, which is 241% annualized. And then our original break-even price, if it went to 883, we're now making a 6.4% return. I think rolling those puts and getting that, 55-cent credit, I want to say, to take our break-even price down to $8.28 was a pretty big move for us. Obviously, we always say the waiting is the easiest and the hardest part of this strategy, so it's really easy to just not touch your brokerage account and do anything with this position, but at the same time, it's pretty hard to watch it day to day without wanting to intervene. That's just a natural tendency that people have when they trade, but we're just going to let this one ride with an 828 break-even price and see what the price looks like come April 16th. And I mean, God willing, this thing will be up to 10 and we'll have this big gain that we'll be sitting on over the course of the next month. But, even if it's down to something like 8, that's still a manageable loss where we could roll these out to May, do the same exact thing, get that break-even price lower and lower and lower as each month passes. So eventually, the price of the stock is going to catch up with our break-even price. That's why we're comfortable with making plays like this, and that's just really how the basis of our strategy works. I guess back to the summary screen that we've got going. ICLN, another pretty small play. It's just a clean energy ETF. UXIN, that one's pretty much done. It's out of, I think, about $1.20, and those are going to expire worthless for us. That was a decent play. AMD, Apple, a couple really strong tech names that we just keep rolling these puts over and over and getting our break-even price down. So those have performed well objectively this week. Hopefully we can get those up to max profit at some point in the next couple weeks and get a nice return on those. And then these GameStop call spreads we've mentioned these a few times. We think GameStop is going to eventually fall and settle back down by April 16th, and we've already seen that starting to happen as it's flirting around that $200 area. SOL, this was when we played literally the week prior. We've got it up in here where we had a decent 1 week return on those, the 16 strike puts. And then, we were so happy about the return we got from those last week that we said, hey, I just saw that it dropped a little bit to 14, so why don't we just sell some 12.5 strike puts that expired in 3 days and see if we could scalp what would be, a $330 profit headed into the end of the week. Well, lo and behold, that premium is typically there for a reason. This thing fell all the way down to pretty much $12.50, almost right on our max profit line, but bounced up decently enough for the next, or at least bounced up decently enough by the end of the day. Hopefully that's enough to hold for the next couple days above this $12.50 line, so we could pull that nice 3-day profit of $330, which in the scope of the amount of money we had invested, it's a 1.79% return. And of course, since that's only 3 days, that annualizes to a pretty funny number, 762%. But that kind of rounds out what we had going for the week. CLOV is another play that we had set up where we rolled these down to 10 strike puts, and I don't think we've actually updated this. Oh, there we go. We have updated it. And then we sold 5 additional puts to increase our stake and get our break-even price down to $9.74. So this one, obviously, the stock has dropped 30% on us since February 10th. That is atypical. Things normally don't move against you that severely, that quickly. But the silver lining to all this is that the strategies we're using allow us to, even though we started playing this when it was at $12.65, we've been able to drop our break-even almost $3 in, just under 2 months. When did we start this? The 10th? Yeah, just over a month, we've been able to drop our break-even price by $3. So hopefully if we can keep up that rate of decline on the break-even price, we could catch a spike from CLOV, and we'll be good to go on that one. But another one where we're just going to sit back, put it in the back of our mind, not do anything crazy on a day-to-day basis, wait for April 16th, and reevaluate once we get there. So with that kind of rounds out where we've been at this week. The S&P 500 is up 0.81%, so that's objectively a solid week in the market. But with this UWMC run we've had, the rebound from AMD and Apple, we've got a 6.08% return. We're outperforming pretty nicely. Here is that chart that we like to have where we benchmark our performance against SPY. And now y'all notice, when SPY does go down, we go down a lot, but when SPY goes up, we go up, a little bit more. So in a sense, we're leveraged to the S&P 500, and that's something that's always important to take a step back and think about, how is my portfolio performing in relation to the market? We got a question in the chat right there. Do we have an updated link to our HT profit tracker? I think what we've got in our Discord should link to it, but I could throw that in there again. In the profit tracker channel of the Discord. And maybe it's a little bit different of a link, but just reposted it in the profit tracker channel on our Discord server. So hopefully you could see that. Let me know if you're having any issues getting in there. We had another question. How do we look at the overall market playing into selling puts? And that's a great question because we always want to keep in mind, market trends when we're entering and exiting plays, because while on a micro scale, there are a lot of different things industry-wise and news for individual stocks and chart patterns for individual stocks, but it's always important to keep the broader market in mind as we make these plays, because if we have a dip in the market, not a lot of stocks are going to be escaping that one. And it doesn't matter how great the setup is on your individual stock. If the market has a significant pullback like we saw at the beginning of March, you're going to be feeling it. So it is important, and that's the reason I do love that this question was asked, in keeping our eyes on overall trends in the market. So we'll talk about this a little bit and what we think about the price action of SPY. This is the 10-day chart, and what we like to mention so often on these streams when we analyze individual stocks, but also the overall market, is this RSI down here, this indicator that we have pulled up, which is the relative strength index. Lets you know if things are overbought or oversold. Anything above 70 is severely overbought. Anything below 30 is severely oversold. So with that in mind, the 10-day RSI is at 68.68, which is teetering on the brink of overbought. And when we look at when this gets into what we'll call getting into the red, when it gets above 70, historically, once this peaked above 70 right here, there was a pretty big intraday sell-off from 387 down to 381. Then it got into the red again the following day, and then there was a sell-off from 389 down to 387. Next time it got into the red was on March 11th, where there was an intraday sell-off from 395 down to 393. And this was after hours, but there still was a sell-off after it hit the red that time. So this goes to show why we think RSI is such a useful indicator in trying to figure out where things are going to peak and where things are going to bottom out. And with this getting back up towards the 70 level, I'm very wary of where we are here in the market. My personal opinion is, based on that idea of psychological barriers in the market, while from a valuation perspective, 400 quite literally means nothing, there are going to be a lot of people who say, okay, the S&P 500, or we'll talk about SPY right here, this ETF has hit 400, it's time to sell. So one good way to analyze what we could maybe expect is looking back at what happened to SPY when it hit 300. So we might have to zoom out a little bit further on that one. But this has happened a few times before. So initially, I got to 294 before dropping pretty harshly in the end of 2018. Got it to a similar level in 2019. And then we did get to 300, and then we broke through by a few dollars and then pulled all the way back to 282. And then we got up to that similar level again and pulled back to the bottom of that candle wick is 285. So based off that, what I expect is that we'll hit 400, and similarly to how we got to 300 and then went over by a couple dollars, I think we'll hit 400, 401, 402, 403, you name it, something in those low 400s, and then see a pullback into this 380, 390 level. And that's just based off, the RSI that we're seeing right now, based off historical activity at these, what you could perceive as psychological barriers for price levels. Just based off that quick analysis, pairing that with the RSI, that's my 2 cents. Obviously, there are a lot of people who go a lot deeper into trends, support levels based off different indicators and metrics. So feel free to supplement that with some of your own individual research. But that is kind of how I'm playing this overall move. And once it does break through 400, if it does break through 400, I'm planning on opening call spreads to play that back down. And we'll be in a situation where if it keeps moving up past 400, we might lose out on those call spreads, but with the positions that we have currently open, we'll benefit greatly from those. So losing money on that hedge won't be too big of a deal for us. So that's how we look at the overall market when we sell puts. And I guess we might have not entirely answered that question. So let's take a look at, Apple, for example. Let's say the S&P 500 or at SPY, that ETF we were looking at, was at 400. And I'm saying, okay, you know what? I think the market's going to go down. What I could do is, instead of opting for something that's a 1.75% return with a break even of 122, I could opt for something that's maybe only a 0.57% return with a break even that is a full, $3 or $4 lower. So the whole game we play, I never think it's a good idea to try to, time the market, pull money out, do something like that. But what you can do if you do want to try to game it and say, okay, I think things are going to pull back this week, is just sell a more conservative strike. Don't go right at the money and try to get that 1.75%. If you think the market's destined to pull back, sell that 120, give yourself a few more dollars a cushion. And then that way, if you're wrong and the market keeps going up, you're pulling still the 0.72, the 0.91%. You're still getting that max profit in the week. But if you're right, you're going to be in a much better situation than if you had been aggressive with these 124s. So that's my take on that. And it works the same way for selling calls. If you think the market is going to go down, maybe sell a call that's almost right at the money so you get the most premium as possible in order to protect yourself against a potential fall, as opposed to saying, you know what, we're going to ride the lightning right here. We think the market's going to run up this week. I'm going to sell a 130 strike call. That's really, the game that we play in determining what strikes to sell. I'm personally believe that as long as you run the strategy that we run, you're going to be okay in the long run, whether the market goes up or down. It's just a matter of patience at that point, like we talked about earlier. But again, if you did want to get in a little bit on that idea of, trying to time the market, picking the strike price that you sell puts at is where that would come into play. Another question, how do we think the market will react since the Fed won't increase rates? So I do think it has been a little bit of an open secret that they're not necessarily going to be touching rates until I think 2023 is what they played around with. But obviously, rates are low right now. That's great for the market. When rates are raised, I think that is when things are going to, when shit's going to start to hit the fan in the market. But since rates are remaining unchanged and we got confirmation of that today, in general, I think that's a little bit of a green light for things to keep pushing upwards. And we could see that's exactly how the market reacted. This is when the Fed released their minutes and released that more definitive statement about not raising rates. We got these two enormous green candles to get us finishing with a pretty nice number in the S&P 500 on the day. However, down the road, I think rates are eventually going to have to be raised, and that is when we might run into some issues. But, with the confirmation that at least in the near term, things are going to remain patient or remain stagnant, rather, I think that's kind of the all clear for things to keep running. But however, I do also want to combine that concept with the concept we were just talking about with SPY approaching 400. I think we could be seeing a temporary pullback, but nothing, if we back up to the 3-year chart, nothing like what we had at the end of 2018 where we dropped from 294 down to 240 in SPY, or anything remotely like what we had in the COVID crash. I think we might see something like what we saw in last September and October, where things were pretty volatile, but in general traded flat overall over the course of those few months. But, with the current rate situation, with the quantitative easing that the Fed has implemented, essentially just pumping liquidity into these banks to ensure that we don't have anything like this and backstop any potential dips like that in the market, I think things will be relatively smooth sailing. And I say relatively smooth sailing, I think this is relatively smooth sailing overall because, 2 months passed and it was pretty much flat, while day to day that might be tough. And then we got a question about why not sell calls when close to 400 instead of puts. So in general, and we could back this chart up just to hammer home that point even further, selling calls is in a sense, timing the market. Now, I do like the idea of selling a call credit spread on SPY because, that gives you a small hedge against an overall pullback in the market. And that way you're still pulling a little bit of money in case things go against you and your main positions are starting to lose cash. But, we look at the last 10 years, the market is always going to go up in the long run. And since we're not in the business of timing the market, we always want to have bullish positions and a bullish outlook on the market. 2011, SPY was trading about, 120. It's since tripled, almost quadrupled from that number in just 10 years, which is pretty damn solid, and we could back up even further just to show this isn't some sort of huge selection bias when we zoom all the way in. We can see things like the 2008 crisis. To an extent, we have the back end of the dot-com crash here in this ETF. But, in general, things in the long run are just going to go up. That's just, how our monetary system and economic policies have been built. So we always want to have that long-term bullish outlook. It's perfectly acceptable if you do get wary of the market, like we talked about when SPY gets up pushing past 400 potentially. It's perfectly valid to say, you know what, I want to take 10% of my portfolio and sell call credit spreads on SPY in order to play it down. I think that's a great way to handle that. But in general, we don't want to size that hedge in such a way that if the market keeps pushing upwards, it makes us lose more money than our long positions are gaining. We always want to have that bullish skew in our portfolio. So hopefully that answers that one. We got a question about selling sundial SNDL calls. This one, I'm assuming you're referring to potentially either call credit spreads or naked calls, which are even more dangerous. And with one like this, it's important to back out, 20-day chart here, probably even further than that. We can go 180-day. In general, I don't think we ever want to sell calls on something that has a chart that looks like this. Because when we sell calls, first off, we're never going to sell naked calls. That is just a level of risk that we're not comfortable with taking on. Second off, if we sell a call credit spread, you are a lot more likely to be at risk of having that long leg hit, which is your max loss point. If you have a stock that's, has the tendency to squeeze upwards like this, where obviously we're probably not going to see something like we saw back in mid-February where it ran from $1 up to almost $5 a share. But even something like from 124 up to 160, or like we just saw today or this week, where just in the last 5 days it's gone from $1.25 and it pushed $2 at one point. That's a little bit too volatile for my taste. And even if you're looking at the premium that these offer, I don't think this amount of premium is really reflective of the amount of risk that you're taking on playing a stock that's this volatile. Question from Marcus in the YouTube chat. Did we do UWMC yet? We talked about it a little bit, but we can talk about it so much more, because why would you not want to talk about something that is a huge portion of your portfolio? And in fact, let's just get into it right now, because we've got that other question about can we touch back on when we'll sell our covered calls for April on UWMC. And then I'll throw that APXT recommendation onto our list from J Marts. Appreciate the question. And a look at LOTZ. We will have a look at LOTZ. Those are our two favorite positions. Bring the UWMC chart up really quickly, and I will take a sip of water before we get back into it. All right, so you cannot stare at this one long enough if you've been someone who's been patient enough to wait along and hold this position as long as I know a lot of us in the group have. This is, one of those days where you feel completely vindicated for all of the analysis and research you've done and all the patience you had as you were holding this, waiting for a day like this. So we finally got it. And it was some very crisp water. When you've got like a tumbler going and you've got a bunch of ice in there, you leave the house for maybe an hour, you come back and the ice is a little bit melted in there and the water is so cold. Probably some of the most refreshing water I've had in my life. But that doesn't help you guys make money in the market, so I'll get back to my point. Anyways, UWMC, how are we going to position what we have here? Let me open the notepad really quickly and pull this onto the screen so I can kind of outline, first off, what we have and how we plan to manage that. And I'm sure at least a portion of the position that we're running is similar to what you guys potentially are holding. So what we first have is the 7.5 strike puts, and hopefully I can figure out how to make this text bigger. Oh yeah, 24. Now we're talking. So let me pull this down. So we've got 7.5 strike puts. And again, these are all 319 positions. We haven't done anything yet for April 16th. But these, I think at the end of the day, we're trading at maybe 2.5 cents, with the average being halfway between the, the bid of 0 and ask of 5 cents. So we're going to let these expire. The 319 9-strike puts, those are a little bit different story. Ideally, we also want to let these expire. And the great part about these is we could flip back here. These were trading for 43 cents at the end of the day, and UWMC got up to, I think, 940 is what we just looked at. After hours, yeah, 940 right here is where this thing eventually settled at 8 p.m. Eastern today when the after-hour trading window closed down. So ideally, we want to let those expire, and what I was getting at is that the best part about this is we are going to suck up so much extrinsic value from these just over the next 2 days by letting them sit. If UWMC stays above $9 a share. Normally it's later in the stream when I start talking over myself, but I guess we're already running into some problems here at the 30-minute mark, so hopefully I'll keep it together for you guys. But just to kind of illustrate that, we've got 20 of these, and they have 43 cents of premium left. So as of right now, on the week, we've had an 1180 profit. But if we knock that down to 0 because they expire worthless, that gets up to a 2040 profit. So we're essentially making $900 more off these just by letting it sit if it stays above 9 for the next 2 days. So that's the initial plan on those, and if it goes back below 9, we might consider, just us personally, we might consider closing those out for a profit, because what we also have are 319 10-strike puts. These we are going to roll to April 16th, and we're going to do this on Friday afternoon, PM. That's a good enough abbreviation for afternoon for sure. So the reason we're going to want to do this is because we could go back here to probably better illustrate this, and when we pull up the extrinsic, as you can see the beautiful position flags next to the 3 positions we have right here. What's funny enough is that these have the most extrinsic value of the bunch. We know that we're going to collect 43 cents off of our 9-strike puts right here, because that's what those are trading for at the end of the day. But if UWMC stays flat, we're going to collect even more from these 10-strike puts. So that's why we want to wait until Friday afternoon, maybe 30 minutes before the market closes. And then we're going to evaluate where these are right here. They have an insane amount of extrinsic value. And like Marcus mentioned in the Twitch chat, those things have $1.26 extrinsic on the 10-strike puts. So what's awesome about this is that $1.26 extrinsic value on the April 10-strike puts, that's going to hold a lot better over the next 2 days than this, which is going to be 0 by Friday afternoon right before the market closes. So we're going to wait for this entirely to dry up, and if this stays at $1.26, that means we're going to be able to roll these 10-strike puts for $1.26 credit, which is a huge reduction on our break-even price just on a month-to-month basis right there. That's an insane amount of premium. The other great part is that this recent spike has driven up the April call premium, meaning if we get, $1.20 of credit on the put side and we sell something maybe aggressive at, 12.5 and get 50 cents of premium on the call side, we're lowering our basis a full $1.70, which it was at $8.20 before. That would put us down to $6.50 break-even price on a stock like this is just obnoxiously good for how long we've been holding it. And, this really is the best case scenario that we've been talking about. Something right before March 19th, a big volatility event that pumps premium into these options. So when we go to roll these from March to April, we're getting some really, really solid credits on the rolls and incredible credit on the premiums for the calls that we could sell as well. But let me get into what we're doing for the calls. The other thing we have right now are 319 10-strike calls. And those we're trading at the end of the day for about 17.5 cents. We'll call that the midpoint between the 15 and the 20 right there. So that means, as long as it stays below 10, which, hell, we don't care. I'd love for it to go to 10 by Friday, but we're basically getting 17.5 cents regardless here. So that's another nice little profit we'll collect over the next 2 days. But where with the puts, we're going to roll these Friday afternoon. What we're going to want to do for the 10-strike calls is wait until Monday. Your question might be, okay, why do we want to wait until Monday to do that if we're rolling the 10-strike puts? And the big reason is the Russell, hopefully there's 2 L's in that, 1,000 and 3,000 index inclusion on March 22nd. So for those of you that, have been kind of following along, might have forgotten exactly what this is and what this means, is essentially this is being added to the Russell 1000 and 3000 indices on Monday. So what is the significance? Why does that matter? There are several index funds that are built similarly to SPY that tracks the S&P 500. There are index funds that are built to track the Russell 1000 and 3000 indices. And once UWMC gets added to those on Monday, those index funds are going to need to buy up a bunch of shares in order to emulate the Russell 1000 and 3000 indices. So a lot of questions we get are, hey, if they know that this inclusion is coming, why don't the indices purchase it today? Is this some of the buying we're seeing? And the answer to that is actually going to be no. Because, your only job as this index fund, at the end of the day, whether or not you make or lose money is entirely based on the index itself. You're not trying to game the market here a little bit. But at the end of the day, your job is to track that index. So let's say they bought UWMC today at 9.05, and then by Monday, it had dropped all the way to something crazy like $7.50. Not saying that's going to happen, but that's the hypothetical for this example. If those index funds were holding UWMC and it dropped 10% before it got added to the Russell index, those index funds are now underperforming the index because the drop happened to their fund, but not to the index since UWMC wasn't included at that point. And because of that, those index funds would not be accomplishing their objective of tracking the index. So in plain terms, what that means is they're going to have to wait until after hours Friday or pre-market Monday to purchase up all these shares. And I think people are starting to understand that because we did see a pretty big jump in the stock today. And one of the biggest, worries that I had was, okay, maybe, the first squeeze we had, it's because Rocket Mortgage was squeezing. So we take a look at Rocket Mortgage. Not even remotely similar. There's not a remotely similar move over here on the chart. So that's great. That's the great piece of news when we look at that, because I think a lot of this is related to this Russell 1000 and 3000 index inclusion, the anticipation of the fact that these index funds are going to have to purchase the stock, as opposed to it just being another, short squeeze or sympathy squeeze based off what Rocket Mortgage was doing. So this was some incredibly encouraging price action today. And I'm really looking forward to next Monday, since we know that they have to do it either Friday after market or Monday pre-market. I'm expecting another pretty big spike Monday. And what do we know about call premium? It increases when the stock increases. So because of that, getting back to circling all the way back to the original point here, this is why we want to wait till Monday. Because of that inclusion, we think the stock is going to spike up on Monday. And when the stock spikes, we think we're going to get much better premiums for these April calls. So while we're rolling the puts, on Friday, we're doing that because we want some skin in the game for when it potentially is going to increase on Monday. But we do want to wait for these calls because we think we can get an even better deal on Monday morning, around noon, afternoon, at least some point during Monday. We think we'll be able to get a great deal on those. And that is why we're holding off. And best case scenario, these shares aren't going to be covered over the weekend since we're waiting till Monday. Something crazy happens over the weekend with this inclusion thing and we open at $12 or something a share. Again, not that that's going to happen, but we like to dream around here. But that would be something where we could just dump the shares and not even have to worry about it, because there is a slight limitation with the strategy, as we saw on the initial squeeze here. When it got up to 12.15, we couldn't do anything about it because we had 10 strike calls and just had to wait and watch as it fell all the way down. At least if this runs over the weekend when these aren't covered, we give ourselves the flexibility of being able to just say, hey, we're going to close these out and let the 10 strike puts that we have run the rest of the way. So that's one we'll just play by ear. As always, wait until Friday afternoon, see how things look. These should be able to expire worthless, no problem. The 9 strike puts, we'll see if it finishes above 9 on Friday with this after hour movement today. I'm hopeful for that. 10 strike puts, we're definitely going to want to roll these, unless, of course, those are also out of the money, in which case we might want to also take profit on those. But again, just hang on tight. We'll probably reevaluate in our Discord server live as we do this Friday afternoon. But I think the most important key here is just roll the puts on Friday, wait until Monday for the covered calls. And, if the best part about this is that if our thesis is wrong and UWMC doesn't go up on Monday, that's okay, because while we were hoping we'd get something way bigger than this on the premium side of things, one day in the scope of something that's a month out isn't going to kill the premiums that much. So we could be wrong about this thesis about this stock just climbing to these awesome levels and giving us some crazy premium, while at the same time not having too much downside risk in case it just stays flat on Monday. We'll just settle for slightly lower premiums than what we're seeing right here. So that is the game plan on UWMC right now as it stands. Any other questions on that one, feel free to throw them in the chat. If there's a way to find current total for free float shares. That's a good question, and honestly, I'm not entirely sure how to do that. Let me do a quick Google and see if we could figure this one out together. How to figure out float size. How to figure out free float, think or swim. How do I check float? Looks like it's possible. Oh, never mind. I just read something that says we can't do it on Thinkorswim. People check it on finviz.com. So there's your quick answer to that. I guess for all the useful things that Thinkorswim provides us with, that is the one thing that we cannot do, is view the free float for the shares. So we'll close out of this window and we will move on to the next stock. Yeah, Finviz, as a lot of you guys are now pointing out in those comments. So we'll move on to the next one that we had suggested. Let me pull up my list to see what the next one we had suggested was, and it is ENPH. So let's pull up the chart first and foremost. ENPH, Enphase Energy Inc. We're going to back up to the 180 day because I think that's our favorite point to start when we look at analysis like this. You'll look at that general trend of it, 180 days ago it was at $44.10, peaked at $229, has since fallen back to $164. It did bottom out around $130 just about a week ago, it looks like. But right now, looking at the RSI, our number one go-to indicator to get a feel for whether something is overbought or oversold, this tells us it's pretty much dead in the middle. So it could go either way here. If you're bullish on this one, that RSI definitely shouldn't dissuade you from doing something like that. But in actuality, I really have no idea what ENPH is other than an energy company. So we'll pull up the Analyze tab. It says it's a provider of energy management solutions. It's engaged in designing, developing, manufacturing, and selling microinverter systems for the solar photovoltaic industry. So I guess potentially solar energy, semiconductor-based microinverter system converts direct current. I got to be honest, I was a business major. I have no idea what half those words mean. So if you've got a little background on this one, feel free to throw it in the chat. But at a high level, it looks like we're looking at an energy company that has a hand in solar. And if anyone has any information on their side that contradicts that, feel free to correct me and let me know. But that is, something we like to talk about and have talked about multiple times. And we've got a comment in the Twitch chat. They make mini transformers for solar panels. Good deal. And something we like to talk about is, the scope of the industry that we're investing in. This green energy area is something we're incredibly bullish on. So we do love to look at stocks in that area. And now let's talk about what we love to talk about so much, and that's going to be option premium. So first thing we're going to want to look at, and the first thing we notice rather is the fact that they do have monthly options as opposed to weekly option chains, but a lot of the time the monthly option premium makes up for that enough. So we'll keep taking a look at this one and see if there are some decent values. Looks like the volume is plenty high enough in order for you to execute a trade on that one. So that standpoint, it looks pretty good. Let's see. We got another comment that fund flow to thematic ETFs was the highest this quarter. So that's also interesting, potentially bullish for the future outlook in that area. Look, I love having you guys in the chat here. I probably just sound like an idiot if I were just rambling on for an hour or 2 hours by myself, only knowing what I know. But I definitely appreciate all this supplemental background information you guys are throwing in the chat as we go through this. I think it's helping everyone out as much as it's helping me out as we analyze these. So back into the option chain. This is one of those where if you wanted to get a little bit, I wouldn't even say risky because we do love selling these really close to expiry options. So the monthly option expiry week is one of the most advantageous times to do that with stocks like this that only offer options on a monthly basis. So if you wanted a quick, 1.64% return in 2 days, it looks like you could potentially accomplish that by selling the 160s. Let's look on the last 10 days. But, March 5th, this thing got down to 129. So what kind of downside protection really does, $2 a premium on a 160 strike put offer you? Now, if you are long-term bullish on this or happy owning shares, and with the strategy that we run here, we always want to do hope that you're comfortable with owning shares on the stocks that you're playing, because if you're not, I would really question why you're playing that stock in the first place. But with that in mind, maybe you don't care about the fact that this is only a $2 cushion, because even though it went down to 130 back a week ago, it jumped back up to 175 pretty quickly. A lot of short-term volatility is irrelevant if you're comfortable with holding something long-term like this. So, not a terribly bad value proposition here. Let's look out to the April premiums. If you did want to sell at the money, or if you wanted to find what we look at a lot, which is an area of support or resistance, it looks like we potentially have definitely a longer term area of support in this 125 to 130 range. That's where it bounced off pretty sharply when it hit there a little over a week ago. And it also spent some time in that area back at the end of November, beginning of December in 2020. So that's not a bad place to look at if you're interested in initiating a position. However, if you look at the 130 strike puts, those are only giving you a 2.15% return on a monthly basis. So that might be something that's a little bit too low based off what you want to target. If you're not terribly worried about that level of support, you're bullish on the stock from right where it's standing at 163.82 as it stands today, you could get a little more aggressive, go kind of just out of the money here with the 160 strike puts for 8.2% of premium. So that's not really all too bad of a deal either. And what we can expect, I guess, forecasting forward about, if you are assigned these shares, one thing that's really important to think about is what kind of call premium would I be able to get on the other side if I were assigned those shares. And looking at the calls right here, it looks like selling just out of the money will pull 13.6, 14.4. So really not too bad a premium there, because if you were assigned on the 160s, that'd be an adjusted basis of 148. And then if you could still get this same 12 or 13 or $14 for calls, that would knock you down to 136, mid 130 basis, which, as we mentioned, mid 130s is right back in this longer term area of support for just, you would have that secondary basis upon selling the calls at the end of April. So just over a month from now, you'd be able to have a break even price in the mid 130s. And that's just assuming this premium sticks around. So another good thing to look at is, can we expect this premium to stick around? And the best way to do that is to throw the implied volatility study up on here. Let's see if it's going to be in the I's, H-I-J. Thank you for bearing with me as I navigate the alphabet here. Implied volatility. And typically when implied volatility is super high, those premiums might not stick around for as long as you would like. But looking in the scope of the last 180 days, implied volatility is actually relatively low, comparable to what it had been offering, for the last half year, as we have pulled up right here. So I think based off looking at that implied volatility chart as it's laid out right here, you can make a pretty good case that this should be a decently steady amount of call premium that's offered to you on a month-to-month basis. So it's one of those things where if you're bullish on this long term, I'd say absolutely dive right into the 160s. And I would do those for the nearest term expiry possible, because you can get a quick $2 a premium before switching over to these. $2 a premium in 2 days, that's really $1 a premium a day, would be the equivalent of, $30 a premium here if you want to think about it on that level. And now I realize what I said might not have entirely made sense, but the idea is you're always going to collect more premium in the final weeks or days as opposed to if you go longer out, because this 232, 283 of option premium on the 160 is going to be entirely gone in the next 2 days. But in the next 2 days, I don't think we're going to see 232 or 283 get knocked off this premium. So you'll collect more cumulative premium if you go with the 160s first, let them expire worthless if that happens, and then get into the April 160s, know that your break-even price is going to be below 150 for that series. And then know that on the other side of things, if you do get assigned on these eventually, you could count on having that double-digit call premium right at or just out of the money. I mean, you could still go $12 out of the money, $11 out of the money right here and get double-digit call premium. So, if this is an industry you like, and it's one that I definitely like, and again, I always say we don't need to have the exact same opinions in here on everything. I just think the only thing that's important that we see eye to eye on is, finding a way to craft a high percentage play in order to act upon your investment thesis. So we got a comment about Visalink VISL. I'll throw that on the list as well. But yeah, I think that should sum up the conversation about EMPH. Jules, I know you mentioned you're about to be the proud owner of 1,000 shares of this one. Is that what you said, 1,000 shares? Let me scroll back up in the chat. Maybe, yeah, you'll be owning 1,000 shares on Friday. Well, there you go. You are about to be able to collect a lot of option premium. Jules, we always wish you the best of luck, and I think you will have the best of luck on this one. I do like the way that the option premium sets up here, so I think that's a really solid play. Yeah, so we do have that one request in for LOTZ. Let's get into LOTZ. LOTZ, and I haven't been using my handy ticker call out graphic that I so painstakingly created in the bottom left here. But let's pop it up on there. We're going right into LOTZ. And I'm going right back into my delicious ice water. Okay. Taking a peek back at the Discord really quickly. And now we are right back into it with LOTZ. No St. Patty's night. It's it's a Wednesday, man. We've also got a I think we're gonna have a tornado coming through here a little bit later tonight, so that kind of puts a little bit of a damper on the St. Patrick's Day festivities. But I was able to get a little bit of it in last weekend, and hopefully maybe a little bit of that'll carry over this weekend here. Who knows? I think Wednesday is potentially the worst day of the week to have St. Patrick's Day, but we'll play that one by ear and see how it looks this weekend. But I got to be honest, I totally forgot it was St. Patrick's Day until you even threw that one into the chat. And you think maybe something Clover Healthcare would potentially have a little bit better of a day on St. Patrick's Day, but that one obviously didn't come true for us either. So I digress. Back to like we got in the Twitch chat, trying to get junk on premium. That is I'm all about it. Let's get back into the actual stock analysis here, and we are going to be talking about LOTZ, our favorite secondary car distributor. What are they? This is Enphase. I was like, this doesn't sound like what CarLotz does. Our favorite vehicle consignment company. Yes. So as we mentioned earlier, and we'll pull back up again just for the sake of conversation, what we did today, we initially sold these March 19th 10 strike puts for $1.17 a credit, which, as we know, our break-even price would be 10 minus 1.17. We initially had an 883. Let me zoom in a little further. Ooh, that's pretty far. But we had an 883 break-even price on this off the bat. And we opened these, I think on, scroll over. Yeah, February 19th. So I guess we could walk back through the timeline of this trade that we had set up. So February 19th is right here, this darker gray. Some would almost call this a black column. When it was trading at about 1038, we were ecstatic about the fact that we sold February 19th 10 strike puts that pretty much came back from the grave for us to get us max profit. So we said, hell, let's jump right back into it. We can get $1.20 a premium basically on the March series, and it's trading above 10 right now, so why not? So that's exactly what we did. It quickly went against us down to 830, but then also went right back up to almost 12. I think this was after, it wasn't after earnings. Earnings were over here, but it did spot back down near 9. Had this same terrible March 5th, I want to say it was, that every other stock in our portfolio had, but again, rebounded after earnings spiked almost back up to $10 a share, and we were so happy about that because we thought, okay, this is great. These expire March 19th. This is going to come right back up to our max profit area, and we're going to pull this one off again. Unfortunately, the second the market opened, basically, those were all given back, and we have fallen back down to the situation we're in at $8.30 a share. So our initial break-even price, as we mentioned, was $8.83. With the stock trading at $8.30, we're obviously sitting currently on a loss. Not ideal, but again, it's unrealistic to think that every single trade you make is going to work out every single time. So with that in mind, how do we handle the losing play? What we did was just, we had a pretty simple roll from the March 19th to the April 16th, and we got a 55-cent credit, which decreased our break-even price by 55 cents from $8.83 down to $8.28. So we have now taken our break-even price from here to here. Now, in the scope of when we're looking at a chart where something has a range of 12 to 645, that might not look like that significant of a decrease in break-even price. But, 55 cents on a stock that's trading for under $10 is pretty damn significant for 1 month. So we're really happy about that roll. And the great part about when you roll for a credit is that, initially, let's pop back into this right here. Initially, if these first puts that we sold expired for max profit, we're making $4,000, we're making $4,000, right? Which would be a 14% return. But now that we've rolled these for a credit, if these hit max profit, we're making more than $4,000. We now have opened ourselves up. Not only have we decreased our break-even price, but we've also opened ourselves up to an even greater return at 20.77%. So that's something that's been, that's one of the, benefits of rolling. Not only do you decrease your break-even price, but also when you get a credit like that, your upside also increases. So we're not terribly worried about this one. I guess long story short is the moral of that story. While things decreased slightly from a break-even price perspective, we have a lot more upside. We'll sit back for another month, wait on that. Earnings are out of the way. Their earnings weren't even, they weren't even that bad. They hit what you could call record numbers. Like the comment we just got from Marcus in the Twitch chat, life's long and there's no rush to hit the home run. We love to leave ourselves open to plays where we can potentially hit home runs like this one. I'd call 20% a home run. But, even if it doesn't happen, we'll put it off another month because our shares, the options we expire the options we sell as long as we roll them over and over, we can hold these things forever. You could play the waiting game with this strategy. You really only screw yourself over if you did something like purchase 10 calls that expired in March, in which case, not a lot of recourse. You could potentially double down, but that is something that would increase your potential max loss. Whereas with our option selling strategies, we have not only decreased our max loss, but also increased our max gain, despite having the stock move pretty sharply against us. And the only sacrifice, quote unquote, that we have to make is the fact that we just have to wait another month. And we got studying right now for the CFA going to bet on us in the Twitch chat. Sorry to hear that. But we definitely hope you have a good night. Appreciate you tuning in. And again, appreciate everyone who's tuned in for us tonight. We love being able to hop on a couple times a week and bounce ideas off you guys, hopefully give you a little bit of analysis and info for the positions you're holding and positions you might be looking into holding. And it helps us, as we mentioned a bunch as well, when you guys give us ideas that we could look at. We could say, hey, this setup is great. I'm going to add this to my list. And when I get some buying power, I might try to jump in on that. We got another question in the YouTube chat. If we created our spreadsheets, and yes, we did create the spreadsheets that we use and that we've shown here, which, calculate our profits, our break-even prices, things of that nature, and do other things. We can walk you through this right quickly. We've got all of our week-to-week stuff tracked here. Sums up all the profit, our average weekly return, our yearly return. We could go flip over here quickly. Sums up things, breaks things out into the profit that we have from our HT wheel strategy, profit we have from spreads, sums that up here as well. And then we have this tab that summarizes our week-to-week performance, our account balance throughout the year. Monthly summary, we chart the account balance because We do have our money in a couple different accounts. Otherwise, it would have been a lot easier to track, but we do this to consolidate what we're working with. And then again, the most important thing in my eyes is we track our performance against SPY using the SPY ETF as a benchmark. And that is probably, and then each of our wheel plays we break out in here just to track them and show individually how successful the things have been for us so far. We've got 36 wins, 6 losses, 85.71% win rate on these plays. And, the losers that we've got right now, Apple's really close to becoming a winner. LOTZ, we just talked about that one. That's pretty close to becoming a winner. iClean, this is a pretty, relatively steady but boring clean energy ETF. That one probably isn't too bad. Really, the only two stinkers, I guess you could say, that we've got right now are Clover and VGAC. But again, we'll just let those ride. And everyone's definitely allowed to use this. We have a template that we made for this kind of a thing that we're looking at on the screen right now. But if you want to copy it, I think if you go to file up here, you're even able to download it into Excel format, or I don't know, you wouldn't want PDF obviously, but you could download this to Excel format. You could copy and paste it into you can make a copy. Yeah, I think there's the option for that if you wanted to run it through Google Sheets as well. And then one of the things that we were talking about a little bit is, since this is something I guess I created, I understand how a lot of this works as far as, adding in new plays. A lot of it, there's a decent manual aspect to this. So we talk about rolling out this potential premium package, I guess, if people want to subscribe. But that's something we're working on right now, where we're hoping to have a HTBBTH. Thank you for the follow. Always got to stop and give the shout out to the people that follow us. Signing up for Twitch just to join the chat. We always appreciate it. We love having people in the chat so much. It makes my night to see you guys popping in and talking with me. But it took a little bit of time to make, and it was one of those things that was kind of a work in progress. We have the 2020 tab hidden in here because this is what it looked like when we first started out. And this is back when my plays were significantly less diverse, and we would just sell puts on something and sell a call spread on something else and let those ride week to week. But based off what we did in 2020, this is when I started publicly tracking, not when I started trading, period. But, based off what we did here, we thought about things we could improve, what we wanted to see, and then parlayed that into our 2021 stuff. So, that's what we're working with so far. Let me hide that one again so you guys don't show the Hyliion weeks. Just because you mentioned that, where is it? We're going to go look at the Hyliion weeks just for a laugh. And we could actually pull up we'll go look at the actual week detail. So, things were going pretty smooth for us. There were, 1,600. We made 2,000. We made 4,000. We made 7,000. We were having a good old time back in the early fall of 2020. However, we had Hyliion shares with the basis of $40, and this is really when the disaster started. This was the SPAC SHLL. We sold 48 strike puts on this when it was trading in the 50s. So, sometimes we exaggerate a little bit when we talk about things in the market, but we quite literally got into Hyliion, or what would turn into Hyliion, at the top. And we rode that thing all the way down. You would not believe just the amount of... we rolled calls down from 46 to 43 to 39. We were eventually selling 38s. We kept rolling our puts down. Lost 17, lost 13, lost 9, lost 6. And when it was all said and done, we could go to the year-to-date summary thing that I had. We lost, $47,000 in October of last year. So a lot of people ask, and this was going back to hammer home the point even further, we were all in on this. Juice3128, thank you for the follow. I always love hearing the notification noise. Sklz, I'll throw that on the list, and we can get to that after this little aside where I am sharing my worst. Okay, we will get to, we've got you, Sierra. We'll get CLSK or EBON up next because you got to get the kids to bed. Totally understand. Finishing up this little aside, we basically lost $50,000 last March. And when people who are trading try to tell you they don't lose money, they're full of shit because stuff like this happens. Now, this is back when we had the mentality that this was just a fun trading account, so we were basically all in on Hyliion. Since then, we have completely diversified our portfolio and diversified the strategy. But I think this is, while, kind of embarrassing to lose $50,000 in a month when you're publicly tracking things, this really just is a testament to the strategy itself, where we could lose this much money in a month. And even what you would think a $50,000 loss in a month would totally screw your year over, even in just this 6-month period that we were tracking, we still made a really, really good amount of money, and we're able to finish the year plus 163% despite a $50,000 loss. So people always ask me, how does this strategy handle downturns in the market? Well, let me tell you, we were all in on something that went from 50 down to about 20 a share, and that's pretty much harder than the market can crash at any point, and we still survived that. So if we can survive what happened here, we could survive any pullback in the market, and that is probably as much proof of concept as I need for the strategies we run. And, I guess maybe the blessing in disguise is I did this when I was trading with, it was 100,000 at that point as opposed to maybe 1 million, but, always some of the most expensive lessons are the best lessons to learn. And hopefully I can impart some of these lessons upon you guys so you don't have to endure a $50,000 losing month in order to learn a lesson. So hiding that and moving on, for those of you that follow us, we'll reference that trade a lot. So that one holds a special place in my heart. But getting back to the stock analysis so we can get Sierra some information before she has to put the kids to bed. CLSK is what we're going to take a look at next. CLSK. Clean Spark. Diversified software and intelligence services company. It offers software and intelligent controls from microgrid and distributed energy resource management systems and strategy design services. I gotta be honest, that sounded pretty vague. HTBBTH, you did some DD on it. Feel free to throw what you know in the chat, because I am just now beginning my due diligence on this one. This is listed at Information Technology by Thinkorswim. We've got, you said the April 16th put premiums are crazy. I've got you. So let's, run the analysis we always look when we're starting something off here. We're going to take a look at the 180-day chart here. And your answer might lie here in the fact that this thing was trading at 225 back at the end of June and is now trading at 24. So any stock like that where we see that it's bottomed out or spent significant time at this, $10-ish or lower level, there's always some, potential immediate downside. And that's probably what that put premium you're looking at is reflecting. Again, this is another one that offers monthly options as well. I mean, you could still get, you could sell out of the money and get 2.62% in the next 2 days. That's pretty damn good on this one. But again, when the premium seems like it might be a little bit too good to be true, that is when we're going to want to take a look. They dropped 22% after public offering, so that's something we're definitely going to want to take a peek at right here. Public offering at $22 a share, so obviously that's something that's going to dilute it. That was on March 16th, which was yesterday, so let's take a look at yesterday's price action. Yeah, so decidedly negative. Just had another one, like you mentioned in the Twitch chat, 22 a share, aiming to raise a total of $200 million. Dilution is decidedly negative for a stock like this, but yeah, VISL is going to be coming up. It's on the list, so don't worry about that one. Stay tuned. We'll definitely get into that because that's one where options are very useful. But back to CLSK. This is one where dilution, never great when you're a shareholder, but pretty significant drop here. They're trying to raise, it looks like, $200 million. Let me, on another tab off screen real quick, check out the market cap of the company. The market cap, okay, yeah. So as of today at this stock price, the market cap is $588 million. So they're essentially trying to raise, another 33% of that. And the stock dropped roughly 33%. So, a decently symmetrical drop in order, corresponding to that announcement. 3.1 million of cash as of September 2020, burn rate of 1.44 million. Good Lord, if they're turning a profit, I doubt they're turning a profit with that kind of a burn rate, but we look here, the EPS TTM, which is trailing 12 months trend right here, it's kind of going in the wrong direction. It doesn't look like they're terribly close to profitability. Return on equity, return on assets, all of those are negative. I'm not seeing anything that's Jules, great catch right there. I made this graphic to point out the stock that we're talking to, and then I just do the worst job of updating it during the stream. So hopefully now the bottom left portion of your screen right now is reflective of what we're looking at. So financial ratios too, long-term debt to capital. Significant amount of debt. Their leverage isn't crazy. No dividend, you don't expect that. Quick ratio, which means current assets to current liabilities, which should be pretty similar to current ratio. Yeah, those are just above 1, indicating they have, just enough liquidity to meet their short-term obligations. So, in the immediate future, especially if they just raise another $200 million off share offerings, bankruptcy isn't particularly a concern. But, you shouldn't even be thinking about bankruptcy if you're on a stock that's gone up 150% since last November. So that's something you definitely want to consider. I think with this one, people do like to make the case that with share offerings, and I think they offered, like we saw, it was 22 or 23 a share, that creates a new price floor. I don't know how much I buy into that theory. If that's something you think is accurate, then this is a great entry point, as indicated as well by RSI being below 50. And you could also get some corresponding premium that is really, really nice. The 20 strike puts, which are, decently enough out of the money. I think that's over 10% out of the money, I believe. Sorry, mental math is starting to leave me past 10 p.m. over here local time. But yeah, I think that you could withstand over a 10% drop and still pull an 11.42% return on capital risked. So from an option selling standpoint, not too bad. That's a really solid return for a month. Your break even here, since you're getting $2 of premium, is going to be $18 a share, which is right around here on the chart. And the last time it traded at this level was mid-December. So, if you think about it in the sense of, okay, they had the share offering. If you prescribe to the idea that $22, $23 share offering is going to be a price floor for the near future. They diluted their company essentially by a third since they raised $200 million off a just under $600 market cap. That was almost reflected all the way. I think the true dilution would be right around here. But again, if you did want to sell those 20 strike puts, your break even would be here. So you're still below that. And you've got what potentially could be seen as a little bit of a support area since it traded around those levels from just mid December 11th to December 18th to be exact. So that could be a decent spot to have a basis for the next month going forward. And then just with the nature of the stock, you could pretty safely assume that you're going to have some decent call premium on the other side of things. As you can see, the first strike out of the money here is offering almost $4 for a call, which would get you theoretically walking through the process of what a typical play for us would look like. If you were assigned with an $18 a share basis, selling an at-the-money call roughly, or just out of the money call for just under $4 of premium, would get you down around just under $15. And that is a number that doesn't look too terrible if you're just looking at the next month or two about where you could expect your basis to be. And again, this is only just the downside conversation because we like to talk so much about the risks here. This thing could shoot back up to 43 and, you'd sleep like a baby making your 11.42% return. So, this is one where, while the chart may be a little bit scary to look at, I think it's one of those things where the value that the option premium provides and, looking at this from, I want to make a high percentage play and be able to absorb a decent drop in the stock, this definitely kind of fits the bill. And if you wanted to get really safe, you could get down to 15. I know 3.63% isn't the sexiest return for a month if you've got 11.42% staring at you just 2 strikes away. But even a 14.5 basis might help you get a little bit better peace of mind on a trade like this while giving you immediately a 14.5 basis, which is much closer to some of these peaks that we're seeing across the longer term on this chart. But, you know, like we mentioned earlier and like we mentioned all the time when picking strikes, that's just kind of the game that we play with the strategy. Do I want to, you know, chew off a little bit bigger piece and go for the nice return because I think there's more upside here? Or am I still a little bit concerned about the downside? I want to play it safer, sacrifice a little bit of return, but the flip side of that is you get a much bigger cushion, which makes it a much higher probability play. So that one, as always, I will leave up to you. I think we've done a good job outlining, you know, potential areas that the price could drop, potential risks on this one, and then also at the same time outlining where you could expect that break-even price to be as the play progresses. So that is where we're going to leave that one. And again, as always, if anyone has some sort of input that they want to add regarding CLSK, any inside info you got, or any personal, you know, bullish or bearish sentiment, always feel free to throw it in the chat as we go through these. So next one we're going to look at, Sierra, if you're still in the chat, let me know. We could do EBON since you did suggest those first. I'll give you a good, let's see, I'll give you a good 20 seconds. If you're still with us, we could look at EBON. But that 20 seconds will also give me another great opportunity to take a sip of this delicious, delicious ice water. All right, she's here. Another crisp sip. All right, EBON, we're going to take a look at that one really quickly. We know that one is a Bitcoin-related stock. Oh, man. You want to talk about RSI? This one's approaching 70 again on the 180 day. And this, again, just to further that conversation we just had with CLSK, which, as I mentioned, that gives me the reminder that I need to update the graphic in the bottom left. There we go. Some significant and immediate potential downside risk, especially off a huge green candle like this from 10 to 12. But, you know, let's look at this trade in the context of where we think we could get our basis, our break even, what the returns are looking like, and the returns are reflective of that perceived downside risk. As we can see, you know, you can go a full $1.78 out of the money from where we finished up at close today and pull a 26.5% monthly return. That is obnoxious. Now, if we want to look a little bit at longer term trends, this has been trading up above 5 for a while. It did dip down to the mid 4s, but not a huge deal, but it's held this at least 5-ish plus price level for a decent amount of time. So this might be another one where you might want to take a step back and say, hey, you know, I could squeeze out 4.93% on something, or I can absorb like a 60% drop in the stock, and that is absurd. And if you have this continued bullish outlook on Bitcoin and cryptocurrency in general, are they a mining company? They are manufacture and sale of Bitcoin mining machines. Yeah, if you think the Bitcoin craze and, you know, hype around all that is here to stay, and you think it could sustain this price level for the next month, I mean, absolutely. If that's your thesis, great way to play that is with those 10 strike puts you could sell, because if you were going to be someone who bought calls, the call premium just right now is absurd. You essentially, if you wanted to buy a 15 strike call, your break even on that would be $17.50, meaning you would need this thing to go up 50% in the next month just for you to hit break even. And that just kind of further hammers home the idea of why we sell these things instead of buy them, because that value proposition is terrible. Now, looking at what we could do on the put selling side if we want to initiate a bullish play on here, that's some attractive looking return on risk. That would give you a roughly $8, give you like a $7.90 basis. These right here would give you a $6.60 basis. So we could go back and look at the chart. First option would give you a basis right around here, when it would just need to hold above that price for the next month for you to make money. The second is the $6.60, which would need to hold above here, which, you know, $7.90 compared to $6.60. I know it's a buck, but in the scheme of things, that's a pretty significant trade-off, going from, you know, a dollar of break-even price as compared to a 13% difference in return. So if you were going on the higher end, I'd definitely be partial to those 10 strike puts. If you're looking at 5 strike puts, this is what I think my risk averse, crypto averse self would prefer these if I had to jump in on a play, because I would love the peace of mind of having a 475 basis while still being able to pull a 5% return. But in general, I do stay away from this type of stuff because, as we like to talk so often about, the biggest risk with this strategy that we run is that the stock just completely tanks on you. And, the decrease in stock price outpaces the amount of premium you're able to collect on the call side. And all of a sudden, the share price is so far below your break-even price that you can't sell calls for any meaningful premium near your break-even price. And one good example of that is Hyliion, which was up above 50 and then got down to 28 within, I don't know, a week, 2 weeks. So fun little callback on that one. But point being, if this thing does what it did back in mid-February when it went from 13 down to 680, you're kind of SOL on that one. And talking a little bit about opinions on crypto, this also may go a little bit against the grain, but I think in general, crypto is a little bit overextended. Can we get Bitcoin prices on Thinkorswim? Yeah, we got Bitcoin futures right here. That's awesome. This chart doesn't scream great entry point to me. The other thing that's funny is we also get RSI on this one, since these are Bitcoin futures, quote unquote. But I gotta think you'd get a better entry point on crypto at some point in the next 6 to 12 months than we have right now. Now, what I say about crypto, you should take with a grain of salt, because one, I'm not right about everything. I try to be right as much as I can, but the reality of the situation is everyone in the market is just making educated guesses, and that's why we run the strategy we run, where in case we're wrong, we have a decent cushion. So, my point is, while I think it's way overextended here and we'll see a pullback at some point in the near future, I was also saying the same exact thing when it hit 40. And as we know from the current price, if you had invested when it hit 40, you'd be up 50% in about 2 months. So, moral of the story, what I say about Bitcoin and crypto is not, canon. But those are my personal opinions on it. It gets to be a conversation of risk versus reward trade-off. Could Bitcoin run up to 100,000? Absolutely. I think that's something that is potentially possible in the future. But at the same time, if you bought it 60%, I think it's, just as likely we see 30,000 again, and you're risking a 50% drawdown in pursuit of what would be, I don't know, like a 50% increase to get up to 100%. So the risk to reward really isn't there for me right now. And it's a similar discussion that we had with GameStop, where, if you thought around here at 130 that this thing was going to keep running all the way to 300, it's okay to buy right here. But when it gets to 250, why would you want to buy at 250 if you didn't want to buy at 130? And I think I have similar logic to where, I didn't want to buy this at 40,000. Why am I going to want to buy it now at 60,000? And I think that's a good question everyone should ask themselves if they're looking at getting into something. Now, if your opinion on Bitcoin is materially changed to where you think there's now this huge upside, okay, yeah, go for it. I think it's always smart to have an investing thesis, play to it, stick to your guns. But has that much changed in the last 2 months with the landscape of crypto? I think the answer is no. But then again, I strictly deal with the stock market, so you could, if that goes against what you think, feel free to tell me to shut up and we can move on to something else. But that's kind of my 2 cents on crypto and where we stand with all that. Next one that we're going to look at is Visalink, ticker VISL. So let me pull that one up really quickly, and more importantly, let me update the bottom left of your screen so it is accurately reflecting what we're talking about. So Visalink is an interesting one because I would say it off the top of my head, but I would rather give you the official company description. But they develop a portfolio of intellectual property, which is embedded in its software algorithms that offer cognitive, interference, mitigation, and spectrum access solutions for a range of applications using the commercial off-the-shelf devices, which sounds like a bunch of tech blab. But the company is a provider of wireless video solutions to broadcast, law enforcement, defense markets, and private mobile broadband networks for use in a range of environments. Reading's tough. The company markets its technology solutions as 3 business units. They've got their integrated microwave technology, Vislink communication systems, and XMAX. And now I do want to say off the top of my head, I think there was some initial excitement about this because they had some sort of connection to SpaceX. Someone feel free to correct me if I'm wrong on that one, or again, feel free to give me a little bit more context on this one if you know more about it than me, which is entirely possible and maybe probable. But looking at it from an investment standpoint, this one I think is super interesting because it offers monthly options at decent strikes, and at the same time offers really decent premiums. What's interesting though is if we want to do calls or if we want to do puts, because that is the one area I think we could have a little bit of a meaningful discussion. As far as the stock itself, I think it puts itself in that category of potentially futuristic, longer term bullish outlook stocks, if that makes sense, or if that was just a bunch of word soup that I was throwing at you. But one of those things where because their technology is applications further down the road timeline wise, people may be a little more understanding of poor numbers in the near future. Even if things dip, people might say, okay, well, this is a stock that's forward looking, it's future focused, now's a great time to buy. So it's one of those things where I wouldn't feel too uncomfortable holding it, on a month to month basis with that in mind. And, talking about that month to month basis, if we wanted to start off with April 2.5 strike puts, we could pull a really nice 10% monthly profit. And if we were assigned the shares, we would be able to hold those with an adjusted basis or break-even price of about $2.25, which sits right about here. And looking at the 180-day chart, not a bad place to be. And now it probably is admittedly a little bit overextended because, like we enjoy pointing out so much, just a few months ago, this thing was under $1.50. It was cheap as hell, but then ran all the way up there. And yeah, like we got a comment in the chat, just like with SPCE, I think the wheel is great for this one, and it offers so much premium relative to the price of the stock that it's one where I think if you're still holding this thing, I don't know what, 4, 5, 6 months from now, you conceivably could have a negative basis or break-even price on the stock, which would effectively make it a risk-free trade at that point. No, and we love anyone who brings up the wheel or even references SPCE. So we love that comment. HTBBTH. I might just start calling you. I was gonna say I'd call you HT for short. I don't know. I feel like that might sound like I'm talking in the third person. I'll stick to pronouncing out every letter. But love that you learned that one. Love that you're referencing that one. But like you said, I think this is a great one to utilize that strategy on. Because if we wanted to jump in with 2.5 strike puts, like I just mentioned, you'd have a 2.25 basis in those shares. Now, what would you do? Obviously, if it dropped down to below 2.5, the 5 strike calls wouldn't be offering 40 cents of premium. But you know what might be offering 40 cents of premium is the 2.5 strike calls if you were hypothetically assigned. And again, we always like to talk about downside protection first before we get into potential upside, because managing that aspect of risk is such an important part of this strategy. So, hypothetically speaking, from the downside, if we were put in a position where we sold these, we're assigned with the 225 basis, I think the move from there would be to then turn around and sell 2.5 strike calls for 40 cents, which would drop your basis to about $1.85. And if those were called away for $2.50 a share, I mean, you're sitting on a 50% gain. I think the value proposition on this one is really, really solid and a great candidate to run the wheel, just because, I mean, we could back out even further. Let's go to the 1 year. This thing has a tendency to spike, go all over the place, and really all you have to do, even if this play lasts 6 or 7 months, just continue. The nature of the stock is such where there's always probably going to be decent enough call premium near your basis. And again, our basis will be sub 250. So, I mean, I would hope so. But all you have to do if you hold on to something like this for 4, 5, 6 months is just catch a spike like this, or a run up like this, a spike like this during one of those months, and you're out of that position and your shares get called away for what would be max profit that month and profit overall on the trade, assuming that we continue to sell calls above our break-even price. So this is one I've actually had on my watch list for a second because I think I scalped a few cents of premium when it was in the mid fours, but I do think, the price level it's at with the corresponding premium that these options offer, I think it's a really, really intriguing play from that perspective. You could start off with something that would pull a 10% return in a month, or if you wanted to get a little aggressive, let's get into that discussion that I alluded to a little bit earlier about what things would look like if you went with the covered calls. So cash secured puts, we see this on the screen right here. Nice and easy. You're getting a 9.89% gain. And I'll just put this right here for reference. But what if we did a covered call? So that would involve buying stock at a price of $3.61, which was the close price today. And then we would sell 416 5-strike calls for a premium, as we can see right here. We'll call it 40 cents to be conservative, but realistically you'd probably get a fill somewhere between 40 and 45 cents. So you'd have 40 cents of premium. What does that mean for your basis? Your basis on this one is going to be the 361 minus the premium you collected to give you a 321 basis in those shares. I'm also going to make this a little bit bigger because I feel like this is tiny what we're looking at right now. All right. So we'd have a 321 basis in the shares. Now keep in mind your potential upside here I guess a little bit of spoiler alert, it's going to be bigger, but the trade-off is that your basis is 321 here, where your basis with the cash secured put is going to be 225. So that's trade-off number one. But let's say that the stock goes up to $5 a share. So if we say the share price on 416 is going to be $5 a share, your gain on the play is going to equal this $5 minus your 321 basis, which is a $1.79 gain, which as a percentage is a $1.79 gain on 321 basis, giving you a 55% return if this thing goes to 5. Whereas if this thing ran away to 5 when you had these cash secured puts, you'd only get a 10% return. And this is one of those, we talk about putting ourselves in positions where we could potentially hit a home run on a trade. I think this is a great example about that, or a great example of that, excuse me. However, you want to, obviously weigh the risks of holding at a 321 basis as opposed to a full dollar lower on something, and while typically in trades we make $1 of break-even price isn't, make or break in the decision we're making. However, when the stock is trading at $3 a share, a potential 33% difference in break-even price is significant, which is why off the bat, personally, sounded like a broken record probably talking about this, but we always want to emphasize downside risk, and I think getting into a play off the bat that would afford you, 10% is good for a month. There's no secret about that, but the best part about this is that 225 basis, where if you are assigned, you could then, hey, I want to turn around and now sell 5 calls with a 225 basis. And if something like that happened, you put yourself in a position where you can make greater than a 100% gain while still being safe on the front end of the trade. So that's, kind of how I approach that. But that is the decision you are forced to make in this as to whether or not you want to jump in with cash secured puts or get a little bit riskier, give yourself a much bigger upside with covered calls. And to be honest, there is a 33% difference in break-even price, but there's also, a 45% difference in potential returns. But then again, the other thing to consider is you have a much higher chance of hitting this return than this return. And we could tell you based off a metric in Thinkorswim right here, probability in the money. So if a 5-strike call is in the money, that means we'll hit max profit on that. So the probability of that is 19.65%. So that means for these 5-strike covered calls, we would have a 20% chance roughly of getting this return. And we would have a, probability out of the money is going to be the flip side of that for calculating the probability that these expire worthless, 66.58%. So there's a 66.58% chance that these cash secured puts expire for max profit. So there is one thing maybe we could look at this to help quantify the difference and the trade-offs is potentially the expected value here. So if you have a 20% chance of getting a 55% gain, if you have a 20% chance, that's going to be multiplied by a 55% gain. Your expected value on this trade is 11%, since the 20% chance of getting 55%. That's your expected value. Just on the upside, there's obviously a little bit more complex of a calculation for expected value that also includes the downside risk, but that would take a little bit longer to calculate. But on this side of things, you have a 66% chance of getting a 9.89% gain. And that's expected value on the upside of 6.5%. And then we got a really good suggestion. You could also sell half the number of puts by half the number of shares, kind of like a mini straddle. We could absolutely jump into a covered strangle on that. And I think that is also a really, really interesting idea. Let's look at how that would look. Covered strangle on VISL. So what would happen, you'd have 100 shares at 361. You would sell one call. I guess we'll say it. -1, 416, 5-strike call, just to give you that upside, and you get 40 cents for that. And then you would also sell a 2.5 strike put. We'll call that one 22 cents, just to give something in the midpoint there. -1, 416, 2.5 put for 0.22. So that means your break even on this trade overall is going to be the 361 minus the 4 and minus the 0.22. So you have a 299 break even on this trade. So that's not too bad. That's a good, happy medium between jumping into those covered calls or jumping into the cash secured puts. I think that's a good, compromise if you are stuck in the middle and don't know which ones you want to do. In fact, looking at this personally, I think I might jump into the 2.5 strike puts here because I like the idea of just having that nice, safe. I mean, it's not a safe 10%. If there were a safe 10% in the market, we would be living on an island somewhere. But safer, comparable to the 5-strike covered calls that we potentially could sell. And I just love that idea of having my break-even price as low as I can off the bat. One of the most frustrating things in the market is when a trade kind of shits the bed on you off the bat and you're not really left with a lot of recourse. This would provide us with a lot of recourse, a lot of flexibility to pivot into 2.5 strike calls for, hopefully when the May or June series get added. But I think these are my personal pick. But again, as long as you're using one of these two strategies, I don't think you could really go wrong because, as we mentioned, that upside potential, if it goes up to 5, is, might potentially outweigh the different break-even price. So it's really kind of a pick your poison, personal opinion type deal. So we got 2 more stocks left on our recommendation list. We're going to try to run through those 2, and then we'll hop off for the night here. I think we're coming up on a couple of hours. So APXT is what we're going to talk about, Apex Technology Acquisition Company. And just for those of you who are still watching, Sklz is going to be the one that we talk about next. And the final stock that we run through tonight. So APXT is Apex Technology Acquisition Company. As always, we're going to look at this. I think it's probably just going to tell us it's a blank check company. There we go. These aren't terribly helpful when you're looking at SPACs. Let's take a look at the news to see who they're merging with. AvePoint potentially is what it looks like. I'm not sure who suggested APXT, but if you got a little info. Yeah, so it looks like they're merging with AvePoint, and of course, we could just AvePoint SPAC. AvePoint to go public via SPAC, valued at $2 billion. They're a company that gives enterprises using Microsoft Office 365, SharePoint, and Teams a control layer on top of those tools. So, as this article right here suggests, why are they up? Trying to take notice of blank check company a month after investor place. Highlighted the planned merger with APXT. So typically, let's talk about the life cycle of a SPAC. Again, we do this a lot. It'll trade around net asset value for the longest time. And then a target will be announced, and this is, I think, what we're seeing here at the beginning of December when it jumps up to 16.58. After that, there will be a lot of volatility, a lot of swings, but eventually the merger will go through, and what we see more often than not is just a brutal sell-off post-merger. One stock, you guys, I don't know if you've heard of this one before. It's called Hyliion. We've never heard of this one before. But, the merger was right around here, and it dropped off sharply after that. CLOV, another example, where it dropped off pretty sharply after the merger. SAMA is now CLVR, excuse me. That one had the merger and dropped all the way down to $8.02. Where else are we thinking here? VGAC is one that had the announcement and then dropped off before the merger has even occurred. So that is a really prominent pattern among these SPACs, is that you'll have a merger and then after that, it'll just completely sell off. So for APXT, although this one does have what seems to be an all right target, a company that's partnered with Microsoft, I presume, the option premium, I'm not sure when the merger is expected, but it looks like the option premium doesn't price in too much of a risk of dropping below 10 in the next month. The 7.53% isn't too bad. At the same time, you've got some, we talk about setting up a home run play. If this is one where you wanted to bank on this thing potentially going to 20, you could still get a decent 25 cents of premium for 22.5, which would essentially be almost a 100% return while knocking your basis down 20 cents to around the $13 level. The question, though, is just whether or not you'd be comfortable holding with a $13 basis, keeping in mind all of these, patterns and things that we've seen with SPACs pre-merger that are heading into a merger. So I don't know the exact date of the merger. I will say if it's after April 16th, this one probably isn't too bad of a play. And based off the way that these options are priced, I think that it's probably after April 16th, because we see there's almost no premium on the 10 strike puts, which means, there's really no risk of it going below 10, which is typical of something pre-merger. But when we look at July 10 strike puts, we see over $1 of premium, which means the merger is probably between April and July. I don't have anything up right here to confirm that, but that's just my educated guess based off of the option premium we're seeing. But in general, I think the way to play SPACs from here on out is play SPACs led by decent groups who have yet to announce a target, because that kind of speculation breeds a lot of premium. Like we were talking a little bit earlier, we could look at PSTH, which even just a week away for pretty significantly out of the money here, you could still fetch $1 of premium on what's basically a weekly. And this is a company led by Bill Ackman that hasn't announced a target yet. So this is one where just the speculation of the target announcement is creating this incredible week-to-week premium. That similar type of anticipation or speculation isn't going to be found on a company that has already had that initial run-up off the target announcement and really just, I don't think, offers you enough premium to get near that net asset value of 10. 12.5 strike puts will get you at about 1160 basis. I'm a little bit wary of, smaller SPACs like this heading into, mergers. Maybe if this is one you like, I'd keep an eye on it. If it drops down below 10 and just completely falls off like the rest of them post-merger, that might be a great time to get in. But as far as an entry and just with the typical life cycle that we see with SPACs like this, I would stay away from that one. And that's going to bring us to our last one, which is SKLZ, Sklz. All right, what is SKLZ? Sklz Inc. All right, it is a technology company that provides monetization services to game developers through mobile esports platform. Okay, so it's an esports play, and I'm glad this one was suggested because that sounds super, super interesting. We talk about industries we're bullish on in the near future. I think everything that I have heard about e-gaming, esports, things of that nature suggests that it's only going to get bigger and bigger as we head into the future. It looks like they have over 40 million registered users, so it seems like a pretty legitimate company. Looking at that one, let's do the 180 day. That's where we like to start. 180 day says entry is all right. It had the run from 1026 up to 4630. This entry obviously would have been pretty bad, but the RSI definitely indicated that as it got up to, good Lord, up to almost 90. That is crazy. Yeah, isn't Sklz basically a smartphone game company? That's a great question. The principal activity is to develop and support an online hosted technology platform that enables independent game developers to host tournaments and provide competitive gaming activity to end users. So based off that description, I mean, you may be correct in the sense that they have a hand in the smartphone game company. It's tough to say just off what we're looking at right here. But it seems like what they're trying to get at for, their business idea is hosting a platform as opposed to, selling smartphone games or things of that nature. So I think just off the top of my head, first impressions, hosting a platform for an area that I expect some pretty significant growth in would be pretty bullish for an outlook on a company like this. Online multiplayer platform that is integrated into a number of iOS and Android games. So that might be, okay, that might make a little more sense as to the relationship between the platform versus the whole smartphone relationship. Sounds a little bit like Twitch. Maybe not, I guess from how I'm interpreting this, maybe not in the sense, okay, that's from Wikipedia. Awesome. Appreciate you throwing that supplemental info. I think Twitch, obviously something more where you watch people stream games. This might be something that, hosts tournaments to track those games as opposed to just being a platform. Friday Legend, thank you for the follow. Always appreciate it. Love that follow noise. But, back to my point, I think this might be something that is a little bit more of a hosting service where they track and, host tournaments and things like that, as opposed to just being a service that lets you watch people games. So I think maybe in my mind, that's the distinction between what's something like Twitch and then something like what this company would bring to the table. But, back to this 180-day chart, we mentioned range of about 10.5 to 46. So this entry here at 29.6 isn't too bad at all. Really, RSI is kind of 50-50 on what this is. But let's take a look at the option premium, which we love to look at so much. We know that it's got monthly options. Interesting here, there's a decent amount of put volume headed forward. We can actually look at the option statistics themselves. 36,000 calls to 21,000 puts were traded today on this one. And again, this takes me back to my the little spiel I like to go into about call and put volume. You never know what someone's motivation is for selling puts. I see so often that, oh man, like 7,800 puts on this one were traded. There's probably someone super big out there who's bearish on this. Well, what if I told you that we sold 7,800 puts and it was a bullish play? It's really tough to tell who's on the other side of a trade. There might be someone that holds a ton of stock in this company, so they're bullish on it, but for whatever reason, they wanted to be hedged for the next few days, so they bought a bunch of puts. Whereas you're seeing a bunch of put volume here, but in reality, it comes from someone who's bullish on the stock, so it really shouldn't be a bearish indicator going forward. So that's why I don't put a ton of stock into option volume like this. Now, what I do think is interesting sometimes is if you see block orders that are pretty far out of the money, those will create a little bit of excitement in the stock and pump premiums a bit, so it might give you a decent entry point from the perspective of the strategy we run, where we try to collect option premium. But that's about as much as I'll look into option volume, as opposed to just making sure that there's enough volume for us to execute a trade. So looking at this one, we could sell so it closed at 29.37. Again, yeah, like Marcus mentioned in the Twitch chat, could be lotto tickets, 100%. We never know what the motivation is, which is why it's tough for me to put a lot of stock into the option flow and things of that nature. But looking at the April series, looks like premium's pretty much gone. I think there might be a little bit, actually on these 30 strike puts, there's still about $1.08 of extrinsic value. So if you wanted to jump in on a play here, I think it's about 3% worth of a return on just extrinsic value from these. So that's really not a bad deal at all. That's one of those where, typically when we sell puts, we want to look out of the money and we see, okay, well, these are only offering 15 cents. But, if it's kind of burying the lead a little bit by ignoring the slightly in the money put, where when we look at extrinsic value, that $1.08 compared to a $30 strike is actually a really respectable return for 2 days in the market, where you could either take assignment and jump into calls right here, which offers some seemingly similarly decent premium, or just close out for a profit, jump right back into April puts, keep the wheel rolling. So that's something to consider if you're looking to get into this one. That's not a terrible entry right here. And it goes against, I guess, slightly against our conventional wisdom of, going out of the money a little bit. Let's see what else we could, seems decently steady-ish over the past, never mind, that's like the past 2 or 3 weeks. Not really steady at all, but we think we probably could see a little bit more consolidation in this 22 to 17 range. So if it's one where you're expecting it to go right back up to 46 or something like that, it might be smart to jump right on shares and then sell something decently out of the money, because you could still get $1.20 a premium in April for 40 strike covered calls, and that would represent a greater than 30% return on your investment. So that'd be a really solid result for 1 month, as opposed to going just out of the money here and getting an 8.11% return. But again, at the same time, these 30 strike, which we could pretty much consider at the money since it closed at 29.37, that 16.5% return really isn't too bad either. So that's just something to consider. If you wanted to play more upside, I think covered calls are the way to go. If you're a little more wary of potential downside because you looked at the chart here, I would suggest either waiting until that downside is realized and we see something back in this 22 to 17 level, or starting off right now by just being conservative, collecting 5% over the next month and giving yourself a play where your basis would be 2150, which is right in that 17 to 22 level that we just identified on the chart. But again, we always would rather miss out on a good trade than be stuck in a bad trade. I do think there is some potential near-term downside here, so that is something I would personally be cautious of. I think a good practice here would just be to set a price alert right around 2250 maybe. If it goes off, jump on that trade. I think that'd be a great entry point. But if not, just let it run. It's so much better to miss out on a good trade than be stuck with an entry right here and trying to figure out how to manage this kind of a play. So there are thousands of other stocks on the market. Just because you like one, but there are a thing or two that are dissuading you from entering into a position on it, it's okay to just leave it alone, set a price alert, and come back to it at a future date. The stock is always going to be there, provided, I guess, it doesn't have some sort of immediate bankruptcy. But that's the best advice I could give on that one. And that was the last stock that we had on our list of suggestions. We're coming up on the 2-hour mark on the stream, so that's typically when we like to cut off these analysis streams. I again want to thank everyone who tuned in with us tonight. I know we've got a lot of new faces in the chat, some people who even signed up for Twitch just to participate in the chat. So I really appreciate all of you guys who join us during the couple times a week that we do these things to give us some feedback and just go back and forth on the analysis that we run on these stocks at the midpoint of the week. As always, we'll have our big weekly trade ideas stream at some point Saturday or Sunday. We'll put out another poll for that in our Discord just to see when the most people are available and we could get everyone hopefully online, because as we like to say with these things, the more the merrier. With that said, I think that's about all we've got tonight. So I'll give you guys the typical sign off we get at the end of the YouTube videos, and is now becoming the typical sign off at the end of the streams. But thank you for tuning in. This has been the Hourglass Trader, where as time passes, we make money, and we will see you guys